It's commonly said that money is made during bull markets, but fortunes are made during bear markets. Why is that? It's because at the depths of bear markets, asset prices are at their cheapest. People have capitulated, and investors, especially retail investors, individuals like you and me, have sold at the absolute worst prices, have gotten out, are scared, and are willing to take subpar prices for the assets that they own. And here's the truth. There are some asset prices that are already there, and there are other prices that will be there soon. This is the time to keep your eyes open, have cash, be ready, because asset prices are getting to the point, if not already there, where we are about to see the lowest they will be in a very long time. And I'm going to give you a few tactics, strategies, tips that I'm using to watch out for when to buy and what to buy. Ready? Let's dive in. I want to show you a few examples of what I'm talking about here. Let's take a look at the price of Apple. Right now, $146 per share. Wouldn't that be great if you could buy them at $4 a share? Well, if you would have bought them in 2008 or 2009 on a split adjusted basis, you could have got them for $3 per share. And right now, even though Amazon is down a lot from its peak last year, Amazon is at $121 right now. But in 2008, 2009, you could have easily bought them for $4 a share, and if you pegged it perfectly, under $2 a share. Monster Beverage Corporation is currently trading at $91 a share, but you had years during bad economic times to buy them around $6 a share. Berkshire Hathaway has come down a lot from its peak last year, still at $280 a share. During the financial crisis, you could have easily bought them for $60 a share. This highlights a couple of things for us. Number one, it's like Warren Buffett always says. You would rather buy a wonderful company at a fair price than a fair company at a wonderful price. Take, for example, Nikola Corporation. This is a stock that is basically just a fraudulent company. They made electric semi-trucks, and then they made videos about them, and then it turned out those videos weren't actually the trucks driving, they were just rolling downhill, and they've had a ton of controversy and fraud and stuff since then. And so this stock has gone from its high of $93 in 2020 down to it's at $3.95 as of the time of this recording. Now you might say that's a wonderful price, and what happens if they come back to $100 someday? But this is not a wonderful company. This is a company that will likely be bankrupt within 2 years. Similarly, if we look at Coinbase, Coinbase is a company that IPO'd around $330 per share and is now trading at $75 per share. You think, well, they've already gone from $300 to $75, how much lower can they go? They can go to zero. That's always the answer. How low can they go? They can go to zero. Terrible company. I've always said, do not invest in this company. I don't invest in any companies that I personally hate. One more example is Robinhood. They IPO'd and spiked up to $84 per share, and now they're down at $10 per share. So we've highlighted two different classes of companies here. One class of companies that are world-class. They're fantastic businesses, and they'll be around for at least decades. And we've highlighted another group of companies that are, brand new. They're the new kid on the block. They've got flashy technology. They're a flash in the pan, though. Probably a lot of them full of fraud and likely won't be around very long. This is the difference between great companies at good prices or good companies or bad companies at great prices. Now, you might argue, and you could be very right about this, that the companies like Amazon and Apple and Microsoft and Netflix and Nvidia and a lot of these big companies that are very strong businesses, and there's, Berkshire Hathaway, tons of them out there, that they have not fallen enough for you to say they're a good deal yet. And that's absolutely warranted. And we're going to get into valuation at the end of this video so you can have some tools to actually determine whether that's an opinion or whether that's more of an objective assessment of a company. But the key thing that we're highlighting here is the strategy is to say, what are the great companies, the fantastic businesses, and then say, okay, Now let's look for good prices on those businesses. We're not starting with price and then looking at the business behind it. We're starting with the business and then watching for a price that we like. The second strategy that's very important during times like this is to invest in income-producing assets. With stocks, this is going to be dividend-paying stocks. There are plenty of very good dividend-paying stocks out there right now that have already taken a big hit in terms of price. And so the amount that they're able to pay out in terms of their dividend is really healthy right now, and their stock price is extremely attractive. You can use any free stock screener out there to search for companies that are of a certain size, so they're included in the major indices, they're profitable, no debt, they pay out healthy dividends, and their valuations are at a decent level. The reason why we invest in income-producing assets during these times is because it gives us income to be able to use to buy the growth assets when they're on sale. Because it does you no good if all the best companies in the world are at dirt cheap prices if you have no cash to use to be able to buy them. Now, many times some of these income-producing stocks won't produce enough income for you, so you can bolster that by the use of things like covered calls. Very simple strategy, selling calls on stocks that you own in groups of 100 shares at a time so that you can produce income on them and use that extra cash for whatever you want, whether that's for hedging purposes or for purchasing additional securities. And then finally, the last strategy here is to actually fundamentally assess a company. Look at the financial statements, look at the ratios, look at their PE, calculate their intrinsic value. Now, some of that is going to be subjective, like the intrinsic value thing, because ultimately what you're asking is how much would you pay for $1 in a year from now? Would you pay me $1 if I was going to give you $1 in a year from now? Maybe, maybe not. Maybe you'd only pay me 90 cents for that $1 a year from now. What if I said, I'm going to give you $1 every single year? How much will you pay me for that? Maybe you'll pay me $2. Maybe you'll pay me $10 if you know I'm going to pay you $1 every single year in perpetuity. But then you have to factor in, okay, well, what are the chances that I just can't pay you that $1 every year from then on? What are the chances that that $1 that I'm paying you might go up? Or maybe what are the chances that that $1 I'm paying you might go down? So you have to ask all these questions. Look at my, in this example, you're looking at my character, looking at my income, looking at my debt to determine how healthy are these things. Can he actually hold up his end of the bargain, this contract? What are the opportunities for that income to grow? So you have to assess all these things. There are some basic calculators out there you can plug in to determine the intrinsic value. And you say, okay, well, based on that, I'm willing to pay $2. And then you look at the price and say, okay, well, it's currently at $3. I'll wait and I'll buy it for $2 if it's ever available for $2. So you do all these things. That's all you're doing. That's all valuation is for these companies. You're looking at Apple, you're looking at Microsoft, Amazon, whatever the companies are. And you're saying, this is a great company if I can buy it for $120, $100, $90, $80, whatever it is. And you set your limits and you wait patiently. You don't have to be precise with these. You just have to know the general ballpark that if Apple is under $100, then it's a fantastic buy. And so if it hits $101, well, you probably still buy. You probably aren't going to be a stickler for that extra dollar. Knowing that you think the value of Apple is $200, you might be willing to buy it at $100 or $101 or $102. You don't have to be a stickler about it. So these are the strategies, the tips, and I'm telling you now is the time to start keeping your eyes open, because for some assets, especially a lot of the tech stocks that are decent companies that are profitable, low debt, a lot of these are down 70, 80, 90% from their highs. They're getting to the point where their valuations are actually pretty attractive considering their growth potential over the next 10, 20, 30 years. There are a lot of other companies, the major ones, the big ones, that they're the generals of the indices. They haven't gotten shot yet, so they're the ones that are still holding up at those higher prices. You want to start paying attention to those because very soon here, there's a very good chance those prices might be at a place where they're very attractive to you. Last tip here, do not be a perma-bear, because there are a lot of people in 2008, 2009, 2010, 2011 that said valuations are nowhere near as low as they need to be. But guess what? The stocks 10x'd, 20x'd, 50x'd since then. And all those perma-bears missed out because they said, no, the stock should be at $3 and it's only at $4. They weren't paying attention to the global macroeconomic situation where central banks were getting easy and there was low inflation, especially compared to today. They weren't paying attention to all that, weren't paying attention to the fact that money was now flowing back into assets by all the big money, and they missed out. So don't be a permabear. Keep your eyes open and always be trying to prove yourself wrong. That's the key. If you think something's going to go down, find the argument against it. If you think something's only going to go up, find the argument against it. See if you can prove yourself wrong so that you know you're not just tricking yourself into doing something that you want to do. So I hope that helps. We've got a bear market here. We've got a recession here. And at some point, it's going to come to an end. And when it does, asset prices are going to be at the best that they might be in a very long time, especially if we're at risk of hyperinflation in the future. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.